Hello everyone. So the market is down almost 1.5%, and the calls that we got yesterday for October and November clearly down. So in today's video, I'm going to give you guys my thought process for the rest of the market and where we can end up going. And I'm going to continue to do my best to explain my thought process and my reasoning for all of my trades. We're going to take a look at the S&P 500, the NASDAQ, the Russell, the dollar, the bonds, the VIX, the yields, the large tech stocks. All right. So without further ado, let's get started with the video. Here's the issue. The smart trade to take is to go long, regardless of how terrible the chart looks, regardless of how bearish the momentum clearly is. The intelligent trade is to lean long here. And that is the issue currently. If it doesn't work, which it might not work, right? We have to sell. And then once again, after another leg down, the intelligent trade to make is still long. That is currently the issue right now in the market. And that is my thought process for the market as a whole. You cannot be really leaning into shorts down here. And it is what it is, honestly. Like, even the same concept with day trading. If one setup doesn't work, you do the same thing on another. Like, if you're trying to go long, for example, right? And this is the one, say for example, this is the 1 minute chart, and try to go long, stop loss, it breaks. You have to try to go long again if you see a huge move to the downside. And that's currently the issue right now in the market. Whether you guys like it or not, that is my thought process. So as we continue to fall here, so very simply, 420 is a very major level of support on the SPY. Below that, we have a very important zone between 412 to 415, basically. And that could be another leg down. And at that point, I'm still going to be long. So it's like, just think about this. As we get down to 420, is that the time to start being short? No. Like, if I was wrong, which, you know, obviously right now, the calls are not doing well, right? If I was wrong, do you shift your like thought process now and start buying longer term puts for a $10 move to the downside? Maybe you could do that, but then it's all, so now at this point, it's all a matter of your risk management. I personally will not be targeting a $10 move to the downside, even if it drops down to 400. That would be kind of crazy. But I don't think that can happen without getting a solid move before that. And basically, if we drop down to 415, you're still gonna have to go long. If you drop down to 410, you're still gonna have to go long. So it's like it's kind of difficult to start being bearish now that there's bearish momentum. What we could do is obviously lean short intraday, but this is currently the issue right now. The market is really, really weak, and we're getting a staircasing down. So there isn't a huge, like, abrupt move to the downside where we can play the reversal in terms of like a rubber band back up. They're staircasing it down and bringing it down very, very slowly. So pragmatically, you know, we failed and closed below this trend line from earlier in the year, end of the year, whenever this trend line was, right? And multiple levels of support, very, very important trend line. So we closed below that. We're right above 420. And you can see that the Bollinger Bands are pointed straight down. So this can just continue falling lower before it even gets overextended. So a lot of people, and it does seem like this is very, very possible, are thinking that 410 is basically a target. 415 is basically a target to the downside. And at this point, you know, we could, if that's the case, right? So now if that's the case for the bears, right? This needs to remain below 424. Comfortable continued move to the downside. So what you're going to be looking for now is 424 as resistance. If we get an impulsive move above 424, then 427 is going to be a major level of resistance. So 424 and then 427, major levels of resistance moving forward. And as long as we could remain below 427, then 415 and 410 are definitely on the table. We could have an impulsive move below 410 down to 400. So now at this point, now it just becomes a matter of taking proper trading setups and managing your portfolio in a proper way. So once again, regardless of whatever trades you're taking, do not overextend yourself or your position to more than 10% of your portfolio for any trade direction. That's the most important thing. So currently, what we did right now is we also bought some December calls. So I bought into December SPY and I think also December NASDAQ calls, because October, November, and December are generally supposed to be very, very bullish. And there's some more information here that I want to show you guys. So I don't know if you guys really care too much about this, but this is some pretty interesting information in terms of historical data from back to 1930. So this is basically explaining a bit of a bullish case into quarter four. All right, so the 2023 S&P was up 19.5% in the first 7 months of the year, January to July. The S&P was down 6.56% in the following 2 months, August and September. Since 1930, there have been 12 prior years where January to July was up at least 10%, and August to September was negative. So since 1930, there's been a total of 12 previous times where this occurred, where basically we were up 10% between January to July, and then August to September was negative. All right, so the following 12th, for all 12 of those times, quarter four was bullish. So the 12 following fourth quarters were all up at least 2% for an 8.39% average quarterly return. So this is more of like a quarterly performance. But what's interesting here is you could see, okay, so January to September, we see the years, we see the percentage that they were up from January to July, and then we see the percentage they were down August to September. So then we see the fourth quarter performance of these 12 times. We see that 2 out of the 12 times we had a negative October. Every other October, 10 out of 12 times was bullish. And then overall, we see each of those 12 times where this occurred in history, the S&P was a green for the quarter. All right, so this is pretty bullish for October, in my opinion, and that's the issue. This is just another reason and another data point that I found that is also showing bullishness for these dip buying opportunities. And it is what it is. If these don't work, if this doesn't work, I mean, it is what it is. 10 out of 12 times in the past since 1930 that this has happened, ended up being bullish for October. Whatever happens now, happens. It is what it is. Okay, so now this is a weekly chart of the S&P, right? So when the SPY drops, so this is a weekly chart. So 1, 2, 3, 4 weeks in a row. This is the current week. But when it drops 4 weeks in a row, there is a 77% chance that the 5th week is green. So if this week isn't green, and then from the last chart, if October ends up being red as well, it is what it is. It's just a statistical anomaly. And in these cases, when there are statistical anomalies that are working against us, the most important and the only thing that matters at the end of the day is your risk management. So that's why, there's been multiple reasons to be bullish. 77% chance of being bullish this week, and 10 out of 12 green months of October when this has happened before. And if none of those work, it is what it is. So so I hope you guys understand that. Just make sure, regardless of what happens, guys, the numbers don't lie. So over time, if this doesn't work out for us, I mean, who cares? Like, then October would just be a bad month. It is what it is. But over time, every other month is spectacular. So it's okay. We have to just be okay with losses and make sure that the losses don't overcome our profits, obviously, but then also just manage the risk so that we don't lose what we can't afford to lose, and that we're always intelligent with how we trade. But yeah, so there's that. Let's just take a look at the dollar and the yields, and then also the VIX. All right, so this is a chart of the VIX. Intraday, the VIX was up almost 15%. It closed at 12.5%. And we already know that when the VIX is up this much intraday, the next day is very, very rarely also green. Very, very rarely also green. So if tomorrow ends up being another... So the VIX is important because it has an inverse relationship to the market, right? So if the VIX is green and showing a lot of strength, then that's obviously bearish for the market because it's inverse. So what I'm saying is it's super, super rare for tomorrow to also be green on the VIX after over a 10% move. So if we get another red day tomorrow, that's another statistical anomaly, and it is what it is, honestly. So I'm expecting us to get a bit of a pullback because statistics dictate and show that the VIX should be either red or flat. And in that case, it doesn't necessarily mean that the SPY would also be green, but it just means that the VIX should not be green. So the VIX should be red. So if, depending on how red the VIX is, we might see a flat or still a bit red SPY. No doubt about it. The SPY can still be red tomorrow, but the VIX should not be green. Okay, so there's that for the VIX. The last time this happened, we were bearish on the market. No, we were bullish on the market because the VIX was overextended to the upside, and then we ended up bouncing. So let's see if that happens again. Cool. Now let's just go ahead and take a look at the yields. So the longer term yields are not super overextended. The 10-year yield is not that overextended. We can see that it opened within the Bollinger Band. Let's take a look at the 20-year yield. The 20-year yield also opened within the Bollinger Band, and then the 30-year yield also opened within the Bollinger Band. So all three of these, it's important to look at the yields because they have an inverse relationship to the market. And when the yields are strong, it means the overall market is weak. So this can still continue to fly before it even gets overextended outside of the upper level of the Bollinger Bands. And we already see that it has history of opening and closing outside the bands. So it's not, an automatic reason to just be bearish. But one thing to consider is that CNBC is calling for 13% rates. So usually when CNBC starts talking very, very bearishly or bullishly about something, the opposite tends to happen pretty perfectly. So yeah, we're gonna have to see if that's the case. On the yields, right? The shorter term yields don't look as overextended at all, but pragmatically the 2-year yield is at a level of resistance, and then the 5-year yield is looking much better than the 2-year, and 5-year looks much closer to the larger yields as well. So we should also take a look at the 1-year yield. Not as clean to look at, but the 2 looks bullish, and the 5, 10, 20, and 30 all look bullish as well. So that is technically bearish for the market. And last but not least, let's take a look at the dollar. The dollar is important to look at because it has an inverse relationship to the market as well. When the dollar is showing strength, and that's overall bearish for the market. And we can see that we're trying to hold above this uptrend level. And this wick to the upside is not really what we want to see, but pragmatically we did close above the uptrend level. But this wick is not what you want to see if you're a bull on the dollar. So if this ends up, pulling back, then this pullback on the dollar should cause the market, the stock market, to bounce. So right now, pragmatically, the dollar does not look too bullish. The VIX also should get a bit of a pullback, but the yields look very bullish. So the yields look bullish. So that means it's bearish for the market. The dollar and the VIX don't look that bullish. So that should be bullish for the market. Cool. So yeah, there's my thought process and all of that. Next, now I want to take a look at the large tech stocks. All right, so this is my thought process of what's going on with the large tech stocks at the moment. So the drivers of the market over the past few months have been AI and chip related large tech stocks. So almost every single time we see these stocks, the chips and the AI stocks, not doing well, we see strength out of Apple and Tesla. So what's going on right now is obviously the whole market, the large tech stocks as a whole, took a hit. Google is still holding above support. Nvidia is still holding above support, still showing strength. And AMD, same concept, right? So as we are seeing weakness out of these stocks, Microsoft as well. Microsoft has just been lagging as well. So Microsoft was like a clear victor because of all of the ChatGPT news, but now it's just underperforming actually. So with money coming out of these stocks, it's causing Apple to maintain its bullish structure and holding support. And it's same concept for Tesla. So until all of these tech stocks start showing, so because right now this is just showing sector rotation, and it's just showing money moving from the biggest winners into the laggers essentially. And Tesla and Apple are holding their own. Amazon is not in that basket, but it's more specifically Apple and Tesla. So if you look at Apple and Tesla, at every single point when there has been a weakness from the AI and chip related stocks, Apple and Tesla would hold their own or start to show some strength. And then once Apple and Tesla start showing strength, then those would get sold off, and then the money would start going back into the AI and chip related stocks. My point of showing you this is that the large drivers of the market and the money that's being rotated into Apple and Tesla are causing things to maintain at levels of support. So yeah, so I wanted to show you guys that. And basically now, we were just already looking at the S&P. We broke below this important trend line, and then we have another very, very important trend line from back November. Multiple touches here, here, here. And now that's basically pointed at this 410 to 415 area, if we can end up getting that. So this is going to be the next very, very major important level of support zone. And that's really all there is to it at the moment. All eyes are on this level now. We broke below this. We have to hold 420. If 420 doesn't hold, there's levels at 417, 418, then 415, whatever. But it really, really boils down to this trend line and this horizontal level of support here at 412. So I'm excited. I'm excited to see what the rest of the year brings. Overall, I hope you guys see my thought process of why it's just a sucky situation to be in. You have to be bullish, and regardless, right? So you could either be bullish, just not put your money in. It's really tough to be extremely bearish here, even though yesterday, like, you could clearly see the bearish momentum. But I mean, it is what it is. You have to take intelligent trades and have stop losses and continue taking more shots, because trading is a numbers game. The more high quality trade setups that you take overall, that's what ends up happening and helping the portfolio. So yeah, man, I hope you guys enjoyed today's video. Please make sure to like, comment, subscribe, do all that good stuff, and I will see you guys bright and early tomorrow morning. Thank you.